The population of Dublin grew almost 3 times faster than had been thought last year, with significant implications amongst other social and economic issues for the city's housing market. John McCartney, Director of Research with estate agent Savills, has delved into the numbers and joins us now in studio. You're very welcome, John. Firstly, just get into the numbers. It had been thought that the most recent CSO figures looked as if the population of the 4 local authority areas, let's put it that way, rather than the greater Dublin area, had grown by 12,000. It's grown by far more.
Absolutely, yeah. The CSO produces its population estimates once a year, and when we referred back to the April 2014 estimates, it looked like Dublin's population was just edging up at about 1% per annum, and that had been the run rate for a while, and that equates to about 12,000 people additional in the County Dublin each year. But the latest published figures indicate actually that the population grew by about 32,000 this year, so 2.5% growth.
And it's your view that in this period of what looks like sustained, strong economic growth, that kind of population growth in the capital is likely to be maintained over the coming years?
Yeah, well, my interpretation of it, Vincent, is that the population responds to the economic opportunities that are there. The current rate of growth is the second fastest rate of population growth in Dublin ever recorded. The only time we ever had anything next nigh or near this rate of population growth was back in 2005, 2006, when we were in the middle of an economic boom. But remember, at that time, we were also receiving large inflows from the 10 accession countries that came into the EU in May 2004.
Well, that begs the question, or do we know where this population growth, where it's sourced from? Is it people coming from other parts of the country? Is it natural population growth, birth over deaths? Or is it our own immigrants coming home, or what?
Well, I think what we can say at a national level is that more people are still leaving the country than coming into the country in net terms. Now that, I suppose, net emigration is declining as the economy picks up and creates job opportunities and people come home and people don't leave in the first place. In terms of the Dublin figures, I think it's a mix of internal migration, so people coming from the country to the city to avail of all those job opportunities.
Or even to college, I suppose.
Absolutely, yeah, that's another factor. And also the birth rate. We have been going through a bit of a mini baby boom. It's tapering off a little bit now, but it has been a factor too.
Now, we already know, God bless us, that how the constrained nature of the property market in Dublin alone, the impact on house prices, certainly up to recently, and rents. What does this higher, almost 3 times higher rate of growth of the population, what implications is that going to have on property supply, property price?
Well, I suppose the back of the envelope calculation, Vincent, is that you take the population growth, in this case 32,000 people, and you divide by the average number of persons per household, which is currently 2.74 people per household. And that gives you a sort of an estimate of how many housing units you would need to build to accommodate this increased population. So when you do that calculation, it comes out at about 12,000 additional housing units would be needed to be built each year to
accommodate. Whether they're apartments or houses.
Exactly, yeah. Residential units.
And we're currently building less than 3?
Last year in Dublin we built 3,259, and unfortunately it's not getting any better this year. We will be lucky if we build 2,800 this year. And even looking ahead, based on leading indicators like commencement notices and so forth, it doesn't seem likely that we're going to get to anything near that target within the next 2 years. So I think what we're going to see is an already very tight market, both in the rental sector and the owner-occupied sector, getting still tighter.
And yet we've seen the rate of house price growth in the capital in particular fall to below 5% recently, perhaps because of the central bank mortgage constraints. Do you think it will continue to fall or stabilise at that rate of about 5%, or do you think this demographic pressure over the next couple of years is going to push the rate of price growth up again?
Yeah, it's an interesting one. Q4 of 2014 was a bumper quarter for the housing market, both in terms of transactions and price growth. And the reason for that was that the capital gains tax incentive for investors was withdrawn in December. So that brought a lot of investors into the market at that time. And remember that the central bank rules actually boosted the market for a period because people piled in and got their legacy loan approvals under the... So I think when we get to quarter four of this year, the figures will actually look quite negative. I think the figures will look more negative before they start to look better, because we'll be comparing back to a bumper quarter 12 months ago.
Of the rate of price growth for property.
Exactly. The year-on-year comparisons, I think, will look probably fairly bleak, but it is really just a base effect, and when we move into the first half of next year, I'd expect that to wash through the system, and then I think we're looking at upward pressure on both rents and prices, just because there's too many bodies chasing beds.
In terms of house price growth, what would you predict, say, by the end of 2016 into 2017?
Well, I think the way I would look at it is, initially, it's going to be tough, I think, until quarter one 2016. Then I think those base effects will have entirely washed through, and then the market will be, I think, driven by investors and other cash buyers initially, and it will be some time, I think, before incomes growth really assists the mortgage financed buyer. We're seeing a pickup in incomes growth. We've now had 3 successive quarters of fairly positive incomes growth, and you'd expect that to accelerate as unemployment comes down, but we really need that to sustain the market going forward. But I think 5 to 6% is where the market is going
for the next couple of years.
I think so, yeah.
John McCartney of Savills, thanks indeed for joining us.